Ever get that feeling like you need one of those secret decoder rings, to crack the code of the finance world,
Yeah.
especially when it comes to insurance, right?
Yeah,
You
totally.
can
Yeah.
feel like a whole different language.
Absolutely.
Well, you're not alone. Today, we're diving deep, and I mean deep, into something called IFRS 17. It's this whole new way of looking at how insurance companies handle their finances, their books, the whole shebang. Think of it like, I don't know, like an X-ray, giving you this super clear view of what's really going on with their money behind the scenes.
That's a great analogy.
Mhm.
Yeah, IFRS 17, insurance contracts, that's our focus today. Really a complete overhaul of how insurance companies, we're talking globally, have to report how financially sound they are, how well they're doing, the whole nine yards.
And you might think, okay, sounds like something only accountants would care about. But honestly, getting to the core of what IFRS 17 is all about, why this change was even needed, and what kind of ripple effects it's having, well, that's actually super valuable for anyone who's trying to make sense of the insurance industry, really. We've got a mountain of material here, the official standards, practical guides, industry reports, even some real-world case studies. We've been digging deep, so you don't have to.
Exactly. We want to cut through all the technical mumbo jumbo and get to the heart of it. Whether you're prepping for, I don't know, a big meeting, trying to understand some article you saw, or you're just curious about the inner workings of international finance, we're breaking this down in a way that respects your time, and hopefully you'll have those aha moments along the way.
So let's jump right in. What is IFRS 17, really? And what were the issues with the old system that made this change so necessary?
Well, IFRS 17 basically replaces this older standard called IFRS 4. And IFRS 4, it had its limitations. It did define, what an insurance contract actually was, but the rules for accounting for those contracts were, well, they were pretty loose.
Because the companies could kind of do their own thing.
Pretty much. So you'd have different companies using totally different approaches, which made it really hard to compare them directly.
Ah, I see. Like trying to compare apples and oranges.
Exactly. And that's where IFRS 17 comes in. The main goal here is to provide information that's more relevant, but also, and this is key, more comparable across the board, different companies, different countries, the whole bit. The idea is to give anyone looking at their financial reports a much clearer, more consistent understanding of where they stand. How much cash they're expecting to get from their insurance contracts in the future and how profitable those contracts are actually going to be.
Okay, that makes sense. Because let's be honest, the financial side of insurance companies, it can feel a bit like a black box sometimes, right?
Yeah, they can be pretty complex beasts. An insurance contract, it's not just one thing. You've got elements that are like a financial product, almost like an investment, right?
Right.
And then you've got elements of a service agreement, where they're promising to cover you if certain events happen. This means they have different ways of making money. There's the profit from the core insurance business itself, we call underwriting profit. Then there might be fees for managing assets in some of their products, and then there's the returns they make on their own investments. IFRS 17 tries to untangle all of that, give us a clearer picture of each of those income streams.
So how does it do that? What are the big fundamental concepts it introduces?
There are two really key ideas at the heart of the IFRS 17 model. One is what we call fulfillment cash flows. This is essentially the current value of all the future obligations the insurance company has under a specific contract, taking into account risk.
Yeah.
So they have to estimate all the cash that's expected to flow in and out, claims payouts, premiums coming in, operational costs, even taxes. And then they have to discount all those future amounts back to today's value, which, money today is worth more than money tomorrow, right?
Right.
And a really crucial part of this is adding an adjustment specifically for the uncertainty in those non-financial risks they're taking on.
Risk adjustment for non-financial risk. Can we unpack that a bit? What kind of uncertainties are we talking about here?
Sure. So we're talking about things like, how many policyholders will actually make a claim, how severe those claims might be, or in the case of life insurance, how long people are going to live.
Right. Those are big unknowns.
Huge unknowns.
Yeah.
So the risk adjustment is basically that extra amount the insurance company needs to hold, kind of like a cushion,
Right.
to compensate for the fact that they're dealing with all this unpredictability.
I see. So it's like putting a price tag on the uncertainty.
Exactly. And then the other key concept is the contractual service margin, or CSM for short. Think of the CSM as the future profit that's baked into a profitable insurance contract, but it hasn't been earned yet.
Okay.
So when an insurer sells a new contract and they expect to make money on it, they don't get to just recognize all that profit up front.
Right.
It's held in the CSM account and is gradually released as the insurance company provides coverage over the life of the policy. It's like recognizing revenue over time as they deliver the service. So for someone like you, observing the industry, this move to recognizing profit over the life of the contract, it suggests that you'll likely see a smoother pattern of earnings reported by insurers,
Yeah.
rather than these potentially big swings from one year to the next that you might have seen under the old rules.
So profitable contracts, they start with a positive CSM, and then that balance gradually goes down as time passes and coverage is provided.
That's it.
What happens with contracts that aren't expected to be profitable right off the bat?
Those are classified as what we call onerous contracts. And with those, there's no CSM at the beginning. Actually, if it looks like a contract is going to cost the insurer more in payouts and expenses than they'll receive in premiums right from the start, they have to recognize that expected loss immediately in their profit and loss statement. It's like, imagine they sell a specific type of policy and then new data comes out and they realize, oh, wow, we're almost guaranteed to lose money on this.
Yeah.
That would likely be considered an onerous contract.
That's a pretty big change in how they handle those potential losses, isn't it?
Yeah, it is.
You mentioned significant insurance risk earlier. Is that the deciding factor, the litmus test for whether a contract even falls under IFRS 17 at all?
It is, yeah. Under IFRS 17, a contract only qualifies as an insurance contract if it involves the transfer of significant insurance risk.
Okay.
So there has to be a real possibility that the insurer will have to pay out a lot more than they've received in premiums because of some future event, something uncertain, that negatively impacts the policyholder.
Could you give us a clear-cut example of what would be considered significant insurance risk?
Of course. A classic example is a life insurance policy with a big death benefit. If the insured person dies unexpectedly, the insurance company has to pay out a substantial sum, way more than the premiums they might have collected up to that point. That's a clear transfer of significant insurance risk. On the flip side, if you have a contract that's mostly an investment, with only a tiny insurance element tacked on, let's say, a death benefit that's barely more than the investment's value,
Yep.
that wouldn't be considered significant insurance risk.
Okay, so what wouldn't be considered an insurance contract under IFRS 17?
Investment contracts that don't have that significant insurance risk element, that's a big one.
Right.
Also, a lot of service contracts where the main thing is to provide a service for a fixed fee, even if there's, some small insurance-like aspect to it. Those would probably fall under a different accounting rule, IFRS 15, which deals specifically with revenue from contracts with customers. So think of an extended warranty on, I don't know, a washing machine.
Okay.
That might be accounted for under IFRS 15. There's also a specific case. If a contract caps the compensation for insured events at the amount needed to settle the policyholder's underlying obligation. So like a loan with a death waiver that only covers the outstanding loan amount, the company can choose to account for that under IFRS 17 or IFRS 9, which covers financial instruments.
So there's some wiggle room in certain situations, some judgment calls to be made.
Right.
Now, you talked about groups of insurance contracts.
Yeah.
Why is that grouping so important in IFRS 17?
Mm.
And does this grouping rule have any implications, for someone like me who's trying to compare different insurers' financials?
Grouping is super important because under IFRS 17, the rules aren't applied to each individual contract on its own. Instead, they're applied to a group of contracts that has similar risks and are managed together. These groups are formed when the contracts are first recognized, and you can't just change them later on a whim. The idea is that insurers manage their business in portfolios of similar risks, right? There is a minimum requirement for how fine-grained these portfolios have to be. They have to be divided into what we call annual cohorts, which means all contracts issued in the same calendar year have to be in the same group.
Right.
But there is an exception that some EU-based insurers can use where they might not have to follow the strict annual cohort rule for certain contracts.
Oh.
This came up during the EU's review of the standard. Often, for a higher level of grouping to be okay for CSM measurement under this exemption, all the contracts in the group have to share 100% of their returns.
Okay.
Meaning the insurer isn't really impacted by how each individual contract within that pool performs.
Interesting. Now, how do those onerous contracts we talked about earlier fit into these groups?
Well, onerous contracts, they're treated a bit differently. If a group of contracts is immediately flagged as onerous, A loss is recorded right away in the profit and loss statement, and no CSM is calculated for that group. Then any changes later on in the expected cash flows for those contracts, they're allocated specifically to that initial loss.
Okay, that makes sense. Another term you used was contract boundary. What determines the scope of a contract under IFRS 17? Like if my car insurance automatically renews unless I cancel it, would the potential future premiums and claims for that renewal period be included in the boundary we're talking about?
Yeah, good question. The contract boundary basically decides which future cash flows are included when we're measuring an insurance contract.
Okay.
And this is especially important when a contract has options for future coverage. The key question is, do those options create real substantive rights and obligations for both the policyholder and the insurer? If they do, then those future cash flows related to those options need to be considered part of the current contract boundary. So with your car insurance, if it renews automatically and you have to actively cancel it, that suggests there's a real obligation for the insurer to provide that future coverage, and you have a right to receive it.
Right.
So those future cash flows might be brought into the current boundary. It gets a bit tricky because insurers might need to estimate how likely those renewals are.
Makes sense. It's not just about the initial period of the policy then.
Right.
Now, insurance contracts can sometimes have parts that aren't strictly insurance, like investment components.
Yes.
How does IFRS 17 handle those?
So IFRS 17 has very specific rules for untangling those different pieces of a contract. If there's an investment component that's clearly separate from the insurance part, meaning they're not closely linked and could basically be sold on their own, then that investment component has to be split out and accounted for under IFRS 9, which is the standard for financial instruments. Similarly, if there are promises of distinct goods or services besides insurance, maybe some administrative services that are priced separately, those would be separated and accounted for under IFRS 15, which deals with revenue from contracts with customers. It's important to note that separating insurance components themselves, it's based on the fundamental nature of the contract, not just how the policy is written or choices the policyholder makes. They're really trying to get at the core of that insurance promise.
Right. So they're really trying to get to the heart of the matter,
Exactly.
focusing on the pure insurance element.
Right.
We talked about fulfillment cash flows, and you said the estimates need to be unbiased, reflect current conditions, and be explicit with that risk adjustment separate. What does that mean in practice for insurers?
It means they have to use their best judgment when estimating those future cash flows.
Okay.
They have to look at all the information they have at the time, their reasonable expectations about the future, consider different scenarios, and assign realistic probabilities to each.
Right.
They're not supposed to try and predict future changes in laws or regulations. That only comes into play when those changes are actually enacted. And as we talked about, that risk adjustment for the non-financial risks, that has to be a separate, clearly identifiable part of the calculation.
Got it. What specific cash flows have to be included in these estimates?
It's pretty comprehensive. You've got all the expected claim payouts, including ones that have already been reported and ones that have happened but haven't been reported to the insurer yet.
Okay.
Then you've got all future claims they're obligated to cover under the contracts, the premiums they expect to receive from policyholders, all the costs associated with administering policies and handling claims, any taxes and levies that are directly tied to the insurance contracts, even costs related to providing benefits in kind, not just cash payments.
Wow. That's a lot. And are there any specific cash flows that are not included?
Yes, there are. Investment returns, they're specifically excluded because those are accounted for separately based on the assets the insurer holds. Then there are cash flows related to reinsurance contracts that the insurer has purchased. Those are accounted for under a separate reinsurance asset.
Right.
And lastly, any cash flows that might come from future insurance contracts, meaning contracts that are outside the boundary of the current policies, those aren't included in the calculations for the existing contracts.
Okay, so it's really about keeping things separate and focused on the specific contracts being measured.
Exactly.
You mentioned discounting those future cash flows, figuring out the right interest rate to use. The bottom-up and top-down approaches our sources went into, those got pretty technical.
Yeah.
Could you give us the kind of the high-level view of what insurers are trying to achieve there?
Absolutely. Basically, they're trying to find the right interest rate, considering both the time value of money. Money today is worth more than money tomorrow, right?
Yeah.
And the fact that insurance payouts are less predictable than some other investments. They have to look at how easy it is to turn those insurance liabilities into cash, how the value of money changes over time,
Hmm.
it has to be in line with what we see in market prices for similar financial instruments. There are different ways to do it. Some start with a risk-free rate and add a bit to account for the less liquid nature of insurance liabilities.
Right.
Others look at returns on certain asset portfolios and adjust those.
Okay.
But the main idea is to get a rate that accurately reflects the time value of money and the financial risks involved.
And what about the risk adjustment for those non-financial risks we talked about? You said it's for the uncertainty.
Right.
But IFRS 17 doesn't give one specific way to calculate it, right? So what are some of the approaches companies might use, and does this lack of a single method lead to big differences in how they report?
It's true. IFRS 17 doesn't say you have to calculate it this way, but it does outline some key things it should have. It needs to represent how much the insurer would want to be compensated for taking on that non-financial risk, and it should factor in any diversification benefits they get from having a diverse portfolio of insurance policies. Some common approaches, there's the confidence level approach, where the insurer wants enough capital to meet their obligations with a certain probability.
Okay.
Then there's the cost of capital approach, which considers the return investors expect for taking on the risk. There are also various margin-based approaches, and they can even combine these.
Right.
Because there isn't one set method, different companies can use different approaches, and that can lead to some variation in the reported risk adjustments and potentially impact their financial results.
Okay, so it adds a layer of complexity when comparing different companies.
Yeah, it does.
Now let's delve deeper into the contractual service margin, the
Yeah.
CSM. You called it unearned profit. How is that initial CSM amount determined when a new insurance contract is recognized as profitable?
When a group of contracts is expected to be profitable, the CSM is set to ensure there's no immediate profit recorded in the income statement.
Right.
It's basically the present value of the future net cash inflows expected from the contract minus the risk adjustment. So it's like all the expected profit from those contracts is deferred and recognized as the insurer delivers the coverage. The thinking is that the value created by those profitable contracts is tied to services they'll deliver in the future.
And how does the CSM change over time? What makes it go up or down?
It's adjusted based on changes in those expected future cash flows that relate to future services.
Okay.
So if they revise their estimates of future claims downward, and this change relates to future coverage, that would usually increase the CSM. If expected future costs go up, that would likely decrease the CSM.
Right.
But changes in expected cash flows tied to past events, like claims that have already happened, those don't impact the CSM. Those are recognized directly in the profit and loss statement in the period they relate to.
So the CSM is always looking ahead.
That's right.
When and how is the CSM recognized as profit in the insurer's income statement?
It's released from the balance sheet and recognized as revenue over the period they're providing coverage. This is often done using something called coverage units. A coverage unit is a way of measuring the insurance protection provided by the contract in a given period. The CSM is then released in proportion to how much coverage was provided. If there are differences between what they expected and what actually happened, what we call experience adjustments, those will also impact the insurance revenue they recognize.
Okay.
So, if fewer claims happen than they thought, that would usually lead to a positive experience adjustment, which increases the insurance revenue.
Okay, that makes sense. Let's go back to those onerous contracts.
Yeah.
So they start with no CSM and a loss right away. How are they dealt with after that?
So, if a group is deemed onerous at the beginning, they record a loss, right?
All right.
In the following periods, any changes in the expected future cash flows for those contracts are split between this initial loss component and the remaining liability for the contract. That loss component acts like a buffer.
Okay.
If things improve and the losses are expected to be less, those improvements are used to reduce the loss component until it's gone. Only then would any further improvements potentially lead to a CSM being recognized.
Okay, so it's like a safety net.
Exactly.
Let's switch gears and talk about reinsurance, where one insurance company buys coverage from another. How does IFRS 17 handle those reinsurance contracts?
Reinsurance contracts, where one insurer, called the cedent, offloads some of its risk to another insurer, the reinsurer, those are accounted for separately from the original insurance contracts.
Okay.
That's because the original insurer still has their obligation to the policyholder, even if they have reinsurance.
Right.
The accounting for reinsurance contracts the company buys mirrors the accounting for regular insurance contracts, but with some tweaks. Any cash flows tied to the reinsurance that depend on claims from the original policies are factored into the expected reimbursements. Non-contingent amounts, like upfront commissions, are treated as a reduction in the premiums paid for the reinsurance. There's also a loss recovery component for reinsurance covering onerous contracts.
Okay.
That can lead to a recovery of some of the initial loss on those onerous contracts. One important thing, a reinsurance contract can't be a direct participation contract.
Got it. What about those investment contracts with discretionary participation features, the DPFs? Those sounded kind of like a hybrid.
They are, yeah. Those are investment contracts where the policyholder gets to share in the returns of a certain pool of assets, but the insurer has some say over the amount and timing of those payouts. These don't usually involve significant insurance risks, so typically they wouldn't be insurance contracts under IFRS 17. But if a company issues both regular insurance contracts and these DPF investment contracts, then those DPF contracts do fall under IFRS 17. The general model we've been talking about applies, but with adjustments for their investment-like features. Often, a simplified approach called the variable fee approach is used.
Interesting. How does IFRS 17 mesh with those other accounting standards we've mentioned? IFRS 9 for financial instruments, IFRS 15 for revenue.
There are definite links. We talked about IFRS 15 for separating non-insurance components.
Right.
The big one with IFRS 9 financial instruments is related to the financial assets insurers hold to back their insurance liabilities. IFRS 17 wants to measure those liabilities reflecting current market info. So when you have financial assets measured at fair value through profit or loss under IFRS 9, changes in interest rates, for example, could make the reported profit or loss fluctuate. The way insurance finance income and expenses are recognized under IFRS 17 can sometimes help offset that potential volatility. Companies also get to choose how they present insurance finance income and expenses. They can break it down between profit or loss and OCI, and this is often tied to how they account for those related assets.
So it's all very interconnected.
It is.
IFRS 17 has been in effect for a little while now.
Right.
What kind of impact has it had, and how did the transition go?
Initially, when IFRS 17 came into play, there were some big changes to many companies' balance sheets, especially in life insurance. It was tough to predict exactly how big the impact would be beforehand because insurers had all sorts of different ways of doing things under the old IFRS 4.
Right, they had a lot of freedom.
They did. So the actual impact for each company depended on how different their old way was from the IFRS 17 requirements and the specific transition method they chose.
Okay.
There were some worries about short-term risks to financial stability, especially if huge insurers were significantly affected, but those were generally expected to be manageable with clear communication.
You mentioned different transition methods. What were the main options?
Companies had three main ways to transition. Full retrospective application, meaning they had to restate their financials as if IFRS 17 had always been the rule.
Okay.
A modified retrospective approach, which allowed for some shortcuts because historical data might not be perfect.
Right.
And a fair value approach, which involved figuring out the fair value of insurance contract liabilities at the transition date.
Yeah.
Interestingly, we've seen companies using all three pretty equally.
Implementing something this big must have cost a pretty penny. What did our research say about the costs of transitioning to IFRS 17?
Studies did find that there were significant upfront costs, things like adapting their systems, handling the separation of risk sharing and investment components, and the sheer amount of work to gather and analyze the necessary data. It all added up.
Yeah.
There was also a sense that those delays in the initial effective date actually drove up costs because companies had to revisit and maybe redo work they'd already done. But a lot of people in the industry felt that beyond just ticking the compliance box, IFRS 17 would bring benefits in the long run. More robust financial reporting, potentially a better understanding of the insurance sector, and more stability overall.
The EU had some specific considerations for IFRS 17, right?
They did, yeah. The EU has its own process for endorsing IFRS 17, and there was quite a bit of discussion, especially about the annual cohort requirement for grouping contracts.
Right.
Some said it was technically sound, others were worried about the practical side of it. In the end, the European Commission did endorse IFRS 17, but they included an optional exemption from that annual cohort rule for certain types of contracts. If a company uses this exemption, they have to disclose that as a significant accounting policy. They don't have to use annual cohorts for those specific contracts, but they still have to apply IFRS 17 when measuring those cash flows, and the CSM is released at a more aggregated level.
So we've seen some early reports under IFRS 17. What are some of the key things we've observed so far?
It's a mixed bag. Some companies reported a higher net profit under IFRS 17 than they would have under the old rules. Many life insurers saw a drop in their opening equity. There was also a lot of variety in how companies chose to apply the standard and the judgments they made.
Right.
And as we talked about, there were all sorts of different methods used for things like the discount rate and risk adjustment. These early reports are giving us the first real-world glimpses into how this new standard is being used across the industry.
All right, let's sum up this deep dive for our listeners. What are the big takeaways from all this?
Well, IFRS 17 is a major shift in how insurers account for their business. It focuses on using current estimates for future cash flows, recognizing profit gradually through the contractual service margin, and drawing a clear line between insurance and non-insurance elements in their contracts.
Right.
The big goal here is greater transparency and a more accurate picture of how insurance companies are performing financially.
So the aha moment here, the key thing to remember, is that IFRS 17 isn't just some arcane accounting rule. It gives us a much clearer, more consistent way to look at the financial health of insurance companies. By understanding these core principles, you, whether you're following the industry or just have an insurance policy, can better understand their financial reports and what's really happening in the insurance world.
Absolutely. And it's still early days. The full impact of IFRS 17 will continue to unfold.
Given all the choices companies have in implementing IFRS 17 and the initial concerns about its potential impact on financial stability, it really makes you think. How will IFRS 17 shape the insurance industry going forward, and how will it influence our understanding of risk and profitability?
That's the million-dollar question. Making sure this standard is applied consistently and interpreted the same way around the world will be crucial to achieving that greater transparency and comparability in the insurance world.
This has been a deep dive, and I mean deep, into the world of IFRS 17. We hope it's given you a solid understanding of this important new accounting standard. What other parts of financial reporting, or the insurance industry for that matter, are you curious about? Let us know, because that might just be the focus of our next deep dive.